Hi guys, welcome back to the channel. My name is Dave and today we're talking taxes. Yay, taxes. I know, not great, but 2022 is fast approaching, end of the year, and I think with a little bit of planning we can save you a bunch of bucks. So that's my goal today. Do that and not drive you nuts with too many crazy definitions. If I can do all that, it's been a success. So if that's what you're looking for, please stick around. Whoop. With this video in particular, I really want to say, disclaimer, I am not a financial advisor and I'm not a tax pro. You should go see a tax pro if you have questions about a specific area. But what I am going to do is kind of share with you my personal experience and kind of show you my personal approach with how I handle my taxes, not just throughout the year, but especially at the end of the year. Some of the things we might be able to take advantage of, or at least what I've taken advantage of in the past. I'll also add some chapters at the bottom so you can kind of jump around to a section if you're looking for something in particular. Quick definition to get us started, and that's ordinary income, or basically money earned from working. So that includes everything from hourly wages, salaries, tips, commissions, interest from bonds, income from a business, rents, royalties, short-term capital gains, and unqualified dividends. All these get thrown into one big pot. This is our ordinary income bucket. But unfortunately, we can't say I made $100,000 on my business, but I lost $20,000 on the stock, so I'm going to offset these two. I wish it did work that way. We'd all be much better off. But what we can do is take individual items within this bucket and have them offset. So today we're going to be talking a lot about tax loss harvesting, essentially taking stocks that we have gains on and offsetting them with those that we have losses with. Tax loss harvesting is very powerful and definitely something to consider. It allows you to offset your gains with your losses that you have. So let's take the short-term capital gains route first. If you made $50,000 in gains that you sold this year, or maybe you've been collecting lots of option premium and you have $50,000 of gains that you've shown. But over here you've got a real stinker. Let's call it Alibaba stock because that one got me pretty good. And you've lost $20,000 on that. So you have the option of keeping your Alibaba stock into next year, or you can sell it this year because you've had it for less than 1 year. And having a $20,000 loss, you'll get to offset your $50,000 gain with a $20,000 loss. So you're only paying taxes on $30,000. And if you think about it, that $20,000 that you're offsetting, if you're in a 50% tax bracket, because these are short-term capital gains that we're talking about, that's going to be $10,000 that you're going to save on your tax bill. So it's very powerful and something definitely worth considering as you come down to the end of the year, if you're an options trader or something like that, to consider selling off those big losses. Long-term capital gains are handled the same way. So if you have a $2,000 gain and you've held it for over 1 year and you sold it, that's going to be a long-term capital gain in a stock, right? And then if you sold something for $1,000 and you held it for over a year, those can offset each other. Once those offset each other, then you can go over and you can find your short-term capital gains, and those can offset each other. And just to confuse it a little bit more, that you can take, if you're married filing jointly, up to a $3,000 loss in this number overall against other income buckets, like your wages, for example. So that would be ultimately the goal. But if you're just focused on the basics of this and you say, look, I collected a lot of option premium, or I sold some stocks this year that I held for less than a year, I would say your goal is to try to find something to pair it up with that is a tax loss, so you can pretty much offset that and not pay any tax on that gain overall. But wait, there's more. You thought you were out of the woods? Don't think so. We got to talk about wash sale rules. So wash sale rules are the ones that are going to dictate whether you can do this in the first place. So we have to be really clear when we sell these things and when we buy these things. Otherwise, they're going to be washed out and won't be able to take this deduction anyway. So wash sale occurs whenever you sell a stock for a loss and for 30 days before or after you, and I'm going to read these so they're accurate. 1, buy substantially identical stock or securities. 2, acquire substantially identical stock or securities in a fully taxable trade. 3, acquire a contract or option to buy substantially identical stock or securities. Or 4, acquire a substantially identical stock for your individual retirement arrangement, IRA, or Roth IRA. All right, so I know that's kind of messy, but I'm going to try to summarize that and show you in this chart. The most obvious important thing to do is to make sure you avoid buying shares in the same stock within 30 days before or after selling. So if you do that, you're going to lose your ability to take that tax loss. Now, it doesn't mean it's gone. Your basis will be adjusted. So if you rebuy too soon, you simply have an adjusted basis and you can sell again and follow the wash rules, and it should all play out fine. You'll get that tax loss at a later date. So it's not gone, it's just delayed. couple other important points here is when I say substantially identical, that does not mean that if you own Verizon and you sell it that you can't buy AT&T. That is fine. It's more about related entities. So if Verizon was buying AT&T, then that would be a problem. So that's usually not an issue. You can buy something similar. But a wash sale also isn't solely about stocks. It can also involve options to buy stock, right? So if you're an options guy like me, then you have to be aware of that. Also, the rule counts if you buy identical shares in different accounts. So if you're buying it in your taxable account and then you're doing something selling in an IRA, well, then that's still a problem. That's still going to involve a wash sale. So you have to be aware of that as well. And finally, for you option traders out there, if you are buying call options, this can result in a wash sale as well. So you'd have to follow the same wash sale rules if you are buying call options. Likewise, selling put options that are deep in the money can also result in a wash sale issue. So see your tax advisor, do your own research on that one, because that one can be pretty in-depth and a little bit tricky. So lots of rules and regulations when we're talking about tax loss harvesting and making sure we get this done right. But with all that said, what do I like to do? So for my personal situation, I collect lots of option premium throughout the year, and I always try to offset that with my losers when I can. So in this year, I've got 3 or 4 of them. And I think in general, it's best to take it when you can in that year, because I would rather just not have that big tax bill and keep that money that I can keep when I can keep it because of the time value of money, which we sometimes talk about on this channel. So generally, it's better to take it now than later. But I hate to sell at a bad point. So we're at that time of year right now where I look at my main 4 losers, which are Alibaba, AT&T, Verizon, and Pinterest. Those are my 4 for this year. And Alibaba, I sold the majority of that earlier in the year, so I already have that banked as taking a loss against the premiums I've collected. But yeah, now the other ones, they've really pulled back because the market's down. So do I sell right now or to wait for it to come back a little bit? Now, I could sell it and quickly turn around and buy something similar, but I have to ask myself if it's right to do those in these particular positions right now. I do think it's kind of funny in a year where so many stocks have done so well that there's a few of these have just gotten really beat up as of late. So you almost wonder if people are trying to get these off their books. If they're trying to do a little bit of tax loss harvesting themselves, make everything look pretty before they go to the end of the year. So it'll be interesting to see if come, let's say, mid-January next year that some of these stocks start to recover a little bit because the money starts flowing back in. We shall see. Not really sure. I don't have anything to back that up. But if you don't see the volume to support it right now and it just continues to drop like we've seen some of these things do, I like Verizon at its current position. So I would be more likely to add to Verizon than I would be to sell Verizon as an example. So one other thing worth covering is all about dividends, because we love our dividends, right? You have all these dividend paying stocks and they're paying you all this money throughout the year. Well, unfortunately, you can't offset that with big stock losses. You can up to that $3,000 limit, but that is it. So don't think I'm going to do a bunch of tax loss harvesting to offset my dividends. It does not work. And another really important part of dividends is understanding the difference between qualified and non-qualified dividends. So typically, if you're buying a U.S. stock, like Citigroup, Kinder Morgan, Qualcomm, that pays a dividend. Now, once you own it, generally 60 days for common stock or 90 days for preferred stock, your dividends that you receive will become long-term capital gains, which is great because you should be paying a lot less for them. However, if it's a REIT like O Income Realty Corp or JEPI, right, the JP Morgan Equity Premium Income ETF, JEPI that I hear a lot about, or the Bank of Nova Scotia, like a foreign bank, then you're going to be paying non-qualified dividends, which means you're going to be paying those higher tax rates. So make sure you understand the difference. So as an example, let's talk about that JEPI dividend versus something like Verizon. These pay what are called non-qualified dividends. And when you receive those, everybody gets really excited because they see those big, huge numbers. But for example, JEPI, which I do own, by the way, pays about a 7% dividend. They pay it monthly, so people love that idea. But you're going to be paying, like if you're in the higher tax brackets, you could be paying about 50% on that. So 50% of 7% is 3.5%, right? Whereas Verizon right now is paying 5%. But you might only be in the 25% tax bracket for that, which means you're receiving 3.75% after tax. So 3.75 is more than 3.5. So you're better off. You're going to get more money depending on your tax bracket just by making sure you're buying good U.S. stocks that pay qualified dividends. So once more, I am not a tax professional. Just have some ideas to throw your way to make you start thinking about things as you go through this, because I think that does help quite a bit. Now, if you have any questions for me that I might be able to answer, please ask down below. If not, please consider like and subscribe to the channel if you found any of this beneficial. We will see you next time. Thanks so much. Have a great night. Whoop.